How's everybody doing on this Friday night, February 7th, 2025? I hope everybody is having a great night tonight. A little change. I was normally doing this on the live stream on Saturday nights at 8 o'clock, but I had kind of a conflict and a change up this weekend, so I'm doing this on Friday night. But you are here in the strategy room with the banker next door, your host, Dr. Joe Berquist, and I'm here, and we're going to be talking all kinds of financial news for the week. I have a ton of great stuff as usual to bring for everybody. So get in, strap in for the next hour and a half as we go on a rock and roll adventure. Well, maybe not all that, but we'll we'll have some fun here going through a lot of this financial stuff. So I'll kick it off here tonight. Big stuff, obviously, today was the job reports, job numbers, all things jobs today. So I wanted to bring this up. This was from EJ Antoni. Basically says it's not just years worth of job numbers that were revised down in today's report, but earnings data too. Turns out the inflation adjusted average weekly paycheck fell even further under Biden than previously estimated. People are earning 16.8% more, but can afford less. So that's that's obviously not good. Not a good chart at all. And then we are going to kick it off here by going through a number of articles related. I mean, there's a number of things here. We're going to look at a couple of zero hedge articles here in just a few minutes. But you can see here Biden's legacy 2024 job numbers revised lower by 600,000. Household survey has caught up to established survey as BLS finally accounts for millions of illegal aliens. Result is employed workers increased by 2.2 million to 163.9 million in January from December due to population-related revisions. And again, the 600,000 lower jobs. January jobs growth below estimates amid massive revisions which trim unemployment and reduce historic payrolls. We're going to get into this article here a little bit later. Forecasting error puts Fed on wrong side again. We're going to look at this article a little bit later on. And then lost in today's job revision chaos. Over 1 million foreign-born workers found a job and no native-born workers. So no native-born citizens. Not good. We'll talk, like I said, we'll look at this article a little later as well. And that gets in here. Americans apparently are the most scammed people in the world. Not really shocked by that. Here's another thing I want to talk about. We're going to get into a little bit later, and that is reverse repos. The Federal Reserve's reverse repo facility hit their lowest inventory in 1,385 days today. Do you know what's coming? It is critical to understand what the reverse repo market is, how it works, and how important it is to basically the liquidity, the overall liquidity in the financial system itself. So we're going to get in and we're going to talk about that a little later. And this is an important thing here. So this is insane. Actually, it is insane. In 2025, 9.2 trillion of U.S. debt were either mature or need to be refinanced. The U.S. now holds 36.2 trillion worth of government debt, meaning 25.4% of the total is set to mature. This is the real reason rates are rising. Yes, that's what I've been saying this for a long time now. So you can see by this blue bar here on the chart, 9.2 trillion. You just see this massive spike of debt. So 9.2 trillion. And this is what I talked about, Janet Yellen. This is the big issue. Janet Yellen left us in this mess. This is what we now have to deal with. She left us 9.2 trillion in debt that has to be rolled over this year. This is Scott Bessent as the new Treasury Secretary. This is his big challenge to how's he going to roll this debt over, and how's he going to roll it over without us having spikes in the 10-year and not only the 10-year, but the longer yield maturities. So this is it right here. This is a huge thing. And this is why the short-term debt is going up, because this is why the longer-term yields, like the 10-year treasury, this is why the 10-year treasury has been going up, because those short-term bills that Janet Yellen put all the money into and now rolling over into longer-term bills. That is forcing the yields up. That's what's happening. That's the dirty little secret that they're not talking about. You have to think of this sometimes like a magician. Like a magician's always trying to, what's a magician try to do? They're always trying to do sleight of hand. Okay, that's basically, think about that. When you think of the Federal Reserve, think of a magician who's always trying to do sleight of hand. That'll help you kind of understand a little bit better what is going on here. They're always trying to tell you half truths and hide the card, basically. Think about it that way. So, all right, well, let's take a look at a couple things here real quick before we get into the kind of the meat of our conversation here on jobs. So where are rates at right now? So let's take a look here at some of the Treasury notes for the minute. So the 10-year note is currently hanging around at 4.496%. We had spiked up here to this is this week's numbers, but if we go back to, let's go back over 3 months here. So we were pushing up. January 13th, we hit our high of 4.7%. We were pushing closer to 5% there, and then their Treasury was able to kind of pull this back down a little bit. We came back down here to just under 4.5%. But that's where we're hanging out at the moment, which isn't terrible, but it certainly is not going to equate to rates going down, right? 30-year bond, we can see here we're still at 4.6%, but let's take a look at something real quick here. So 10 years at 4.4. Where's the 2-year? 2 years at 4.3. And now the 3-month bill is also at 4.3. So we are back to, again, what we're back to a positive sloping yield curve. Not drastically, but it is back to a positive sloping yield curve. I don't have quite the chart up here displaying that, but that's where we're at right now. Now, like I've said before, is that a good thing or a bad thing? Well, depends on a number of factors. Normally, it's a good thing. However, I would say we just came out of the longest and deepest yield curve inversion on record. And when that happens, historically, that means you are going to hit a recession at some point in the next 3 to 6 months. So right now, I would say that that's not a good thing, that is a bad omen. And we'll, like I said, we'll see what comes in there. But like I said, I just wanted to check in on where rates are at right now. Let's look at a couple other things for a second here. So gold futures, you may notice here, gold futures is at 2,886. So gold has drastically been going up here over the last couple of weeks. Now, what is one way to interpret the gold price going higher? Well, you could also, one way to think about gold is a hedge against inflation, and it's also a hedge against bad performance. Now, whose bad performance? Oh, the Fed's bad performance. The Federal Reserve does not like to talk about gold because gold, in a very real way, is a judge of how the central bank is doing. And when you see gold spiking like this to all-time highs, that usually tells you that means people are afraid and they're buying lots and lots of gold. And they're doing that because they're not happy with the job that the Fed is doing. So central bankers do not like to see this, and they do not like to talk about this because this is judgmental on them. So just think about it from that perspective. That's one. I mean, there's a number of ways to think about gold, but that is one way to think about gold's performance. Is that it is a judge of the job that central bankers are currently doing. So just wanted to point that out. What else do we see here? Well, silver futures are sitting about $32. Oil right now is hovering about 71 for crude. Brent's at 74. Not too horrible. And that's where we're at there for that. So like I said, I wanted to point out the gold. The gold was pretty big, a pretty big thing at the moment. I wanted to point that out. Okay, here's I love showing this. I think I'm going to show this every week now. Here's our U.S. debt clock, and how are our boys at Doge doing over here? Well, they have plucked out apparently $69 billion so far. Not too shabby, but nowhere near where we need to be. The number, unfortunately, the number right above them, the $2 trillion U.S. federal budget deficit, that's the number we have to clear away. We can't just, $100 billion that's all right. but that doesn't even make a dent. So in other words, the situation is the spending is at $7 trillion. We basically bring in $5 trillion in taxes. So we have a federal budget deficit, an annual budget deficit of $2 trillion. And this is what needs to be cleaned up. This is what needs to be cleaned away. Now, I saw some headlines today with President Trump and Elon, flouting that perhaps they could balance the budget. Maybe. I personally think that it will take a number of years to be able to balance the budget. I don't think that they're going to be able to do it in one foul swoop this year. I think that that's probably very unrealistic. But hopefully they can make a dent this year. I mean, if they could get rid of, somewhere in the neighborhood, if they could cut somewhere in the neighborhood of $500 billion to $1 trillion this year, maybe get another trillion next year, and then so after 2 years they finally bring it down to a balanced budget. I think that would be good, and would definitely get us heading back in the better direction. But again, the $36 trillion in national debt here, not really not really looking too good not really looking too hot at the moment. Still, our debt to GDP still hanging out here at almost 123%. Pretty ugly number. But like I said, I like the Doge clock, and like I said, we'll probably check in. Like I said, I'll probably make this a standard thing every week just to check in, see how the boys at Doge are doing. So, but okay. So, what happened here this week? So last week I talked about how Scott Bessent got put in he got finally confirmed as the new Treasury Secretary. Rohit Chopra got fired as the head of the CFPB last week. So what happened? Trump names Treasury Secretary Scott Bessent acting director of the CFPB. As former head Chopra confirms, he is out. So President Donald Trump appointed Treasury Secretary Scott Bessent, the acting director of the Consumer Financial Protection Bureau. Bessent announced in a CFPB statement. Former director Rohit Chopra posted a letter to Trump on social media platform X confirming that his term at the agency had concluded. Chopra was often at loggerheads with the U.S. banking industry after pushing to drastically rein in practices around credit card fees and overdraft fees, among other efforts. So Bessent, a former hedge fund manager who was confirmed as head of the U.S. Treasury on January 27, will presumably lead the CFPB until a permanent pick is named. I look forward to working with the CFPB to advance President Trump's agenda to lower costs for the American people and accelerate economic growth. Banking groups had expected Chopra to be fired as soon as Trump was inaugurated, but Chopra remained for a few more weeks. Continuing to fire off releases and weighing in on hot button topics, including whether banks unfairly closed accounts. While Chopra's term was scheduled to run for roughly another 2 years, basically, Supreme Court ruling said that he could get rid of him. We got all that. But the agency has since been targeted by trade groups who unsuccessfully argued that the CFPB's funding violated the U.S. Constitution, and more recently by conservative figures, including ex-owner and Trump advisor Elon Musk, who has called for the elimination of the CFPB. The Consumer Bankers Association said Monday it was pleased by Bessent's appointment at the CFPB and that Bessent should take steps to reverse partisan policies made under Chopra. We're hopeful that Secretary Bessent will take into account the real-world ramifications regulators have on America's leading banks, the millions of consumers they serve, and the economy as a whole. So now let's flip to something else for a second here. Just looking for something. Thought I had something here. That's CFPB rule. All right, I thought I had something. All right, so, but basically, what I'll say in other news tonight is that everything on the CFPB, or everything that the CFPB working on, at least temporarily, has been put on hold. So that was one of the big things that basically came out of this. Scott Bessent got in this week. He immediately put everything on hold. He told everybody in the organization basically, hey, stop working, stop everything you're doing, stop all legal action until we could basically take stock of what's going on there, really get our hands around everything that's going on. Like I had reported on over the last few weeks, just something that was very unusual. Like I said, normally after an election, when you have a changeover in administrations, normally that period, that kind of what they call the lame duck session, normally during the lame duck session, which lasts about 3 months, normally it gets very quiet in a lot of the regulatory agencies, because usually everyone's like, okay, we kind of did what we could for the last 4 years. We're basically done. Now, we're on our way out. The new administration is coming in. So, they try to maybe tie up a few loose ends, wrap a few things up, and then basically prepare to hand off to the next administration. But that's not what the CFPB did. The CFPB, man, they went full bore, pedal to the metal the last 3 months, and it was like every other day they were just, hey, put this rule, finalizing this rule, finalizing that rule, putting this in, putting that in, putting the other thing in. And like I said, even up until the last day that Chopper was there, he was still, weighing in on issues, firing out, different letters and different things to people. So, again, I think that Scott Bessent, I think he did the right thing by basically, just putting the brakes on everything for the moment and saying, okay, we need a timeout here. We need to back off and take a breather and kind of just see what's going on here and what we need to do. So like I said, we'll see what happens with a lot of this here over the next few months. All right, let's see here. So this was interesting. So this says, in a switch, Trump approves of the Fed's decision to hold interest rates steady. So President Donald Trump commended the Federal Reserve for its decision last week to leave interest rates unchanged. Holding the rates at this point was the right thing to do, he told reporters. I think a lot of people were shocked by this, especially based on Trump's comments at Davos, where he basically said he was going to demand that the Federal Reserve bring interest rates down. So President Donald Trump agreed with the Federal Reserve for its decision last week to leave interest rates unchanged, an early pivot from his previous demand that the central bank ease immediately. In an exchange with reporters Sunday, Trump said holding its key borrowing level in a range between 4.25 to 4.5 was the correct move for the Fed. I'm not surprised, he said, regarding the decision. According to multiple reports, holding the rates at this point was the right thing to do. The statement stood in stark contrast to one Trump delivered when speaking remotely to the World Economic Forum in Davos in a January 23rd appearance, where he said he would demand the interest rates drop immediately. The president has no direct authority over the Fed, though he does nominate the chairman as well as other board members. Current chair Jeremy Powell is a Trump nominee and a frequent target of the president's criticisms. Markets don't expect the Fed to lower rates until at least June. In his post-meeting news conference last week, Powell repeatedly asserted that the Fed doesn't need to be in a hurry to lower further after shaving a full percentage points off the federal funds rate from September to December in 2024. The Fed's decision-making got potentially more complicated after Trump on Saturday said he would impose aggressive tariffs against Canada, Mexico, and China, the three largest U.S. trading partners. Economists worried that the tariffs will drive up prices at a time when inflation has shown signs of easing. Well, I guess that depends on what you mean by showing signs of easing. So I think it was definitely a surprise that President Trump basically said that, hey, he agreed with the decision for right now. Again, I think he did that because he had, a lot of, there's a million things going on every single day. I think he was more focused on the tariff stuff this week as opposed to, going after or fighting with the Fed on the Fed's decision. I think it was absolutely the right move for the Fed at this moment to not continue to reduce rates. I did not think the Fed should not have reduced rates a few months ago. And everything that I was worried about happening is exactly what happened. And that is that the Fed reduced rates, the 10-year Treasury went up. It completely nullified everything that the effect that the Fed was trying to have. And then you had inflation start to tick back up over the last 4 months as they were lowering rates. That was my big fear. And again, I am far more afraid of reigniting inflation than I am of higher interest rates, because higher interest rates you can deal with. Higher inflation you cannot. Inflation will kill your wages, as we've all experienced over the last 3-4 years. Inflation's a killer, and you can't outwork inflation. If inflation were to go back up to even if when it goes back up to 7, 8, 9, 10%. That's a killer. You can't outwork that. You can't earn enough money or get enough wage increases in a short period of time to make up for that drastic increase in inflation. So, again, that's my big fear. And I went back a number of months ago. I should probably go back over that again. So I spent a lot of time going over what the Federal Reserve did in the 1970s. I looked at a number of charts. I talked about the mistakes that the Fed made in the 1970s. And I was basically very afraid that the Fed was going to repeat a lot of the mistakes that they made in the 1970s. And what happened was literally almost the same pattern that we're currently living in. The Fed basically, there was an election year came up around 75. The Federal Reserve, inflation had spiked. They raised interest rates. Inflation started to come back down. The Fed said, "Oh, we've tackled inflation. We're good now, and we're in an election year." Does this sound familiar? But instead of 2024, this was 1975. And so the Fed immediately started to bring rates down. Well, what happened? Inflation spiked through the roof, and inflation went up to 18%. And that's when we had the Paul Volcker moment. That's when the Fed hired Paul Volcker. Paul Volcker came in, jacked interest rates way up to basically break the back of inflation and bring it down. But in the process of doing so, caused one of the worst recessions that we have ever seen, basically from 1980, 1981, 1982. Just an absolutely horrible, one of the worst recessions in history, was caused by that whole action. And that's what I'm afraid of. I'm afraid of the Federal Reserve bringing rates down too much, too fast, and basically reigniting inflation again to the point where we have another potential, Paul Volcker moment where now we have to hire somebody else to come in, jack up interest rates and bring it down. That's the fear. That's my fear. And so I think the Fed should have I think 4 months ago, they should have just left rates alone. They should have. And I think if they would have waited another 4 or 5 months, I think inflation might have come back down to 2% or just below 2%. But because they were too fast on pulling the trigger there with reducing rates, you're now not only has inflation gone back up, it never even got close to hitting back to 2%. It kind of stalled out around 2.5%, and now it's ticking back up, not a lot, but it's ticking back up closer to 3%. And if you look at some of the core numbers like core CPI, core PPI, core PCE, these numbers are slightly over 3%, 3.2, 3.3, 3.4. Very troubling, very troubling. And so I'm of the frame of mind where it is quite possible that the Fed may they not reduce rates this year. They may have to put the rates back up. And a lot of people are, they're not even thinking that. I mean, you've got a lot of economists that are saying, oh, we should have at least a couple rate cuts this year, 2, maybe 3 rate cuts. And right now, I will say this right now, right this minute, I do not see any rate cuts this year. I see 0. But like I said, we'll see. I mean, who knows? As the year goes on, things could get a little bit more favorable. But let me go back to this for a second. Let's look at this here. Let's find this right here. This 9.2 trillion. This is the elephant in the room right now, and this is what is going to have what's going to have the biggest effect on interest rates this year. Right here, this 9.2 trillion dollars of U.S. debt that has to be rolled over this year, which is almost 25% of the total amount of our total national debt. This is going to have an enormous impact on rates as we go through the rest of the year. And if rates get driven up, this will be exactly why they get driven up, because of this. So, but let's go back. Okay. So now the Treasury Secretary says Trump wants long-term interest rates to fall, but it may take a while. So we're kind of following up on these comments from Trump basically saying he agreed with the Federal Reserve. Now we got Scott Bessent this week basically saying that, hey, no, Trump does want the rates to come down, but he also recognizes that it's probably going to take a little while for that to happen. So Treasury Secretary Scott Bessent said Donald Trump is looking for longer-term interest rates to fall. Bessent said in an interview Thursday that Trump's policy should influence those longer-term borrowing costs to fall. Analysts, however, think that there isn't much room for long-term borrowing costs to fall in the near future, which I have a tendency to agree with. I really don't think that there is much room for them to fall. So Treasury Secretary Scott Bessent is looking for lower, longer-term interest rates, but a significant drop will take time. This week, Bessent said Donald Trump is focused on implementing policies that lower long-term borrowing costs on anything from mortgages to business investments to U.S. government's borrowing from global investors. In an interview with Bloomberg Television on Thursday, Bessent said that the benchmark 10-year U.S. Treasury yield is going to naturally come down as Trump's policy of energy dominance, deregulation, and non-inflationary growth takes shape. But for now, long-term rates are indeed coming down after spiking following Trump's election. However, some investors are still worried that tariffs and a fresh round of tax cuts could drive up inflation. All right. First of all, I have to say this. This is the whole tariff thing is ridiculous, and it drives me nuts. People need to understand that the tariff thing, it's a negotiation tool. What happened on it was almost comical what happened on Monday. On over the weekend, Trump goes out and he says, I'm putting these tariffs on Canada and Mexico. And of course the market opens down on Monday and everybody's panicking. Oh, we got these tariffs. The tariffs are going to destroy the economy, etc. What happened? I think it took less than 12 hours for both Canada and Mexico to completely fold like a three-piece suit and run back and basically say, well, no, we don't need to do that. We don't need to do that. Hold on, stop, put the brakes on. Let's talk about this. Let's negotiate, whatever. And and Trump got exactly what he wanted out of it in the short term. He got exactly what he wanted out of it. He wanted the border closed. He wanted more. He wanted them to contribute more security to the border. He wanted to really work on stopping the fentanyl from coming across. So he got exactly what he wanted for the moment. And now they'll negotiate over the next month and see what happens. But so I don't want to completely downplay the effects of a potential tariff because, a tariff coming on wouldn't necessarily be a great thing. It can hurt the economy. However, you have to look at the potential imbalance. I think we get, 10%, 15% of our stuff from, or we sell 10 or percent or so of our stuff to Mexico. Mexico sells 70% of their stuff to us. So while a tariff might harm us, a tariff from Mexico may harm us, our tariff on them wrecks their economy. It wrecks their economy, like as in they're done. And they obviously, Trump knows that. I think smart economists out there understand that. So it's, again, they're going to come back to the table because to them, for Canada and Mexico, these tariffs are life and death. It's not feel a little bit of pain, have a little bit of cost go up. It's life and death. And again, yes, there are going to be some tariffs on some countries. Trump that's all part of his strategy is to raise. So in other words, think about it like this. You need more money. You got to close this. It's what we just looked at here with the debt clock. You got a $2 trillion federal budget deficit, right? So what are the two ways you close that? You close that by either reducing spending or you increase taxes, right? One or the other, or maybe you do a little of both. So they want to reduce the spending and they want to increase the taxes, right? But they don't want to increase the taxes on the people. So he's going to go and increase taxes on other countries. Okay. So you can think about it that way. It's either you pay more tax or the other countries pay more tax. I'm in favor of the other countries paying more tax. How about we cut our taxes and we charge these other countries more tax? I'm totally cool with that. And I think that's how this will ultimately end up. So but like I said, I get annoyed with the whole, like every article is like this with the tariffs, the fresh round of tax cuts could drive up inflation. Oh, it's the end of the world. Oh, it's just, it's ridiculous. It's so ridiculous and so overblown. What you have to understand about tariffs again is it's a negotiation tool. It's a negotiation tool. That's what you have to think about it. Aside from the military, aside from perhaps government sanctions, tariffs are the most powerful tool that the president has at his disposal. It amazes me that more presidents in years past have not used tariffs because they literally are the ultimate weapon, so to speak, for any president to use. And again, you see what what did he do with Panama? What did he do with Colombia? He just he just threatens these things, and these countries are so terrified that they immediately come running back to the table. So, and again, and I also think it's a joke too, because if you remember to the first time around, Trump came out at the beginning of his first administration and basically said, "Hey, I'm going to renegotiate all these trade deals." And of course, everybody, all the mainstream media, CNBC, Bloomberg, they're all like, "Oh, this guy's nuts. He can't renegotiate these trade deals. That is never going to happen." And what happened? He renegotiated all the trade deals. And while they may not have been perfect, they were certainly, 90% better than what we had before. So I would highly, just say like, hey, take a break, take a breather. Let's wait and see what happens, and then we can go from there. So, again, but again, it goes in here like what is influencing long-term interest rates. So Trump has long wanted lower interest rates, and during his last administration, publicly pressed the Federal Reserve to cut its influential federal funds rate to make borrowing cheaper. The Fed has more control over the short-term rates used on credit cards and other short-term lending, but longer-term rates like the 10-year Treasury yield or mortgage rates are more driven by inflation, government borrowing, and other long-term factors. Yes and no. So I would remind everybody that during back when the Fed was doing all their QE, when they were doing quantitative easing, that was highly influential on long-term rates. The Fed was through quantitative easing. The Fed was able to artificially keep longer-term yields lower, and they could do that again. But right now, they are basically in a tightening mode, meaning that they are actually trying to bring down their balance sheet. The Fed has been successfully reducing their balance sheet a little bit over the last year, and they want to continue doing that. If the Fed, flipped that around and basically started buying more bonds and treasuries on the longer end of the yield curve, they could bring those longer term rates down. But of course, they don't want to do that right now. And part of that may be good, but I think part of that is also a political thing too. But of course, they don't make zero mention in here of all of the shenanigans that Janet Yellen did. I tell everybody right now, everything that Janet Yellen did, it's going to come out. It is going to come out, and when it does, there's going to be people here that are going to be shocked, like, wow, my gosh, I can't believe this, whatever. And I want people to remember that you heard it here first. You heard it here first. I tried to tell you all the crazy stuff that she did over there at the Treasury, worst Treasury secretary in history. I want everybody to remember that. And her, and again, I've talked about it a million times. You really have to go back and look at my Lords of Easy Money series if you really want to understand all the shenanigans, all the things that have happened there over the last, say, 15, 16 years. But you go back, you watch that Lords of Easy Money series, you'll understand all this stuff that I'm talking about, all this stuff that is happening now. And you'll really understand that dynamic and the relationships there between Powell and Yellen and Ben Bernanke, what I call the three amigos. Thick as thieves, those three are, as they say. Okay, but let's continue on here. So what happened with the employment reports today? So employers added fewer jobs than expected in January. So the U.S. employers added 143,000 jobs in January, the slowest job growth since October, while the unemployment rate declined to 4% from 4.1% in December. The job slowdown is unlikely to influence the thinking of officials at the Federal Reserve, who are not feeling any pressure to boost the economy by chopping borrowing costs. The job market has settled into a groove of relatively slow hiring and low unemployment. So says some people. The job market settled further into its low firing groove in January as employers added the fewest people to their payroll since October, while unemployment unexpectedly declined. The data showed recent trends in the job market intensifying. For months, employers have avoided both hiring and layoffs. The job growth has slowed significantly since the post-pandemic explosion of demand for workers that made hiring and wage spike in 2022. Despite slower hiring, the job market has stayed resilient, and the unemployment rate has hovered at levels that aren't high by historical standards. Okay, I want you to keep all this in mind. There's a reason why I'm reading this, because we're going to see this in a second here. So then this next article. So here's where the jobs are for January in one chart. So let's go down and take a look here. So January jobs, 1 month net change. So healthcare and social assistance were up 66,000. Retail trade was up about 34,000 jobs. Government was about 32,000. So let's think about this for a second. So healthcare is heavily subsidized by the government. So it is government. You could think about it in terms of this. It's government spending that in a very real way is influencing that healthcare hiring. So think about it in terms of that. So the government, in a certain respect, I'd say in a very real respect, is not only responsible for the 32,000 in government here, but I would say they also play a very big hand in the 66,000 here. So you could almost equate 100,000 jobs here as basically being retail or government activity related, so to speak. Financial activities, 7,000 jobs, construction, 4,000 jobs, manufacturing, 3,000 jobs, wholesale trade, and then leisure and hospitality cut 3,000 jobs, mining and logging cut 7,000, and then professional and business services cut 11,000 jobs. So, but also think about it like this too. Say you take out this healthcare and you take out the government. So you take out about 100,000 jobs here, right? How does this look? How does this job report look if you take those two things out? Doesn't really look too good, right? You're only talking about growth of probably about 45,000 jobs. Not too great there at the moment. So, okay, now let's take a look here real quick at a couple of these Zero Hedge articles. And I would encourage, I love Zero Hedge. Zero Hedge is a phenomenal website. They do really, really great analysis. And I like looking at them because you could think of it as like two sides of a coin, right? CNBC, Bloomberg, Fox Business, the Wall Street Journal, they're over here. Zero Hedge is over here on the other side. So I think it's important to look at both sides of the coin, both sides of the argument, and then because the truth, as they say, always lies somewhere in the middle, right? So we heard the one side, the mainstream media side. Now let's see the other side of the accord. So January jobs growth below estimates amid massive revisions which trim unemployment and reduce historic payrolls. Oh, that's kind of interesting. We didn't hear anything in those other articles about massive revisions. So there were no strong convictions ahead of today's jobs report, perhaps because everyone by now knows the numbers are all bogus and made up on the spot. And perhaps this time it was a good thing because while on one hand, the payrolls print came in weaker than expected, driven by a sharp drop in private payrolls, the unemployment rate actually dropped below estimates, painting yet another mixed picture of what to expect. Here's what the BLS reported in Trump's first official report since he returned to the White House today. Total payrolls printed 143,000, down sharply from an upward revised 307,000, 256,000 originally, and missing estimates of 175,000. Looking further back, the change in total non-farm payroll employments for November was revised up by 49,000 from 212,000 to 261,000. And when adding the 51,000 revision to December, employment in November and December combined is 100,000 higher than previously reported. But while the sequential change in the estimated survey was notable, what was far more remarkable was the household survey, where we saw massive population-related revisions discussed, well, they talked about last night, which pushed the civilian labor force higher by 2.2 million to 170 million, while the number of employed workers also increased by over 2.2 million to 163 million. As a result, the household survey has finally caught up to the establishment survey. There was a big gap in this survey for pretty much the most part of the last year, basically. But you see this giant upward revision here from the household survey, which is in red. Usually if you see a big gap between these two, it's a bad thing. And continuing on now, and since the number of unemployed people actually declined to 6.8 million from just slightly up there, while the number of employed workers rose by 2.2 million to 163 million, the unemployment rate declined to 4% from 4.1%, and the lowest since May of 2024. According to the BLS, the unemployment rate for adult men, 3.7, adult women, 3.7, teenagers, 11.8, whites at 3.5, blacks at 6.2, Asians at 3.7, and Hispanics at 4.8, showed little or no change in January, although, as can be seen on the chart above, white unemployment is dropping notably, while black unemployment rate is rising. So despite the drop in the unemployment rate, the participation rate actually rose modestly from 6.25% to 62.6%. Some more quantitative details from the report. The number of long-term unemployed, those jobless for 27 weeks or more at 1.4 million, changed a little in January. The long-term unemployed accounted for 21.1% of all unemployed people. All of this, of course, and here's the big thing. This is the big thing. All of this, of course, is in the context of the massive downward revisions to 2024 payrolls, which we discussed, and which look as follows. Roughly 600,000 jobs lost every month last year. Wow. Wait, what? As they say, the record just stopped there. Let me read that again. Roughly 600,000 jobs lost every month. And let me blow, see if I can I blow this up a little bit more so everybody can hopefully see this just a little bit better. So you can see here the difference. January, negative 511,000. February, negative 525,000. March, negative 589,000. You're starting to get the picture here. April, minus 579. May, minus 602. June, minus 633. July, minus 689. August, minus 696. September, notice it's going up. September, 711,000. October, 710,000. November, 661,000. December, 610,000. So taking a closer look at the annual revisions, which we discussed and which affected both the established survey data and the household survey, this is what the BLS said, starting with the establishment survey. In accordance with annual practice, the establishment survey data released today have been benchmarked to reflect comprehensive counts of payroll jobs for March of 2024. These counts are derived principally from the quarterly census of unemployment and wages, what's called the QCEW, which counts jobs covered by the unemployment insurance UI tax system. The benchmark process results in revisions to not seasonally adjusted data from April 2023 forward. Seasonally adjusted data from January of 2024 are subject to revision. In addition, data for some series prior to 2020, both seasonally adjusted and unadjusted, incorporate other revisions. So the seasonally adjusted total non-farm employment levels for March 2024 was revised downward by 589,000 jobs. On a not seasonally adjusted basis, the total non-farm employment level for March 2024 was revised down by 598,000 or negative 0.4%. Not seasonally adjusted, the absolute average benchmark revision over the past 10 years is 0.1%. So the over the year change in total non-farm employment for March 2024 was revised from 2.9 million to 2.346 million. And here is the household. Effective with data for January 25, updated population estimates were incorporated into the household survey. So I'm not going to get, I would continue to kind of go down here. But this was the big news. This was the big thing here in this article, was that basically we saw this massive revision down. And keep in mind, this was only for one quarter. So we're going to get 3 more quarters like this. So if you add it out, what is that? So they're saying that we had, well, at least in that quarter, we created roughly 2.9 million jobs, and now it got revised back down to about 2.3 something million. But we're ultimately going to have probably somewhere in the neighborhood of 2.2 million jobs that basically never existed. They were put out there as if they were created, but they never existed. That is the big bombshell from this. That's the big takeaway. Of course, you didn't see that. We didn't see that in any of these, right? Investopedia didn't have that in here. CNBC didn't have. We had no comments on that, right? Nothing about that, right? Just a little minor miss, right? Little minor miss in there. You ready? Keep going here. Here's another bombshell. Lost in today's job revisions chaos, over 1 million foreign-born workers found a job, and no native-born workers found a job. That's fascinating, right? Slowly, the unprecedented payroll fabrication of the Biden administration, which we spent much of the past 4 years exposing to our readers, is starting to unravel. Earlier today, the BLS confirmed what we previewed last night and admitted what we had been saying for much of the past 3 years, that most of the job gains in the past few years, and especially 2024, were a mirage. And following the dramatic August 2024 preliminary data revision, which vaporized 818,000 jobs, which had never existed in the first place, as we continue on here, today we finally saw the details behind the near record revision. As part of its annual revision to both the establishment and household survey today, the BLS said that the seasonally adjusted total non-farm levels, again, were down 589,000. We went over that, but I want to get down to the juicier stuff here. In short, just as we have been warning since early 2024, the wheels of the U.S. job market were falling off in mid-2024, and by the time Trump came on board, the jobs market was become one giant Potemkin village on the verge of collapse. For anybody who doesn't know, the Potemkin village, that was a village over in Russia where they basically set up like fake houses along the waterway, and they did this whole dog and pony show where they basically made it look like there was all this construction and all this development, but it was actually just a mirage, a big giant mirage. All right, okay, I want to get down here because some of this stuff. Let's see here. But let's get this. So the BLS reported that in January, over 1 million, or 1,045,000 to be precise, foreign-born workers found a job. And as Standard Chartered explained first in June, this is largely illegal or undocumented aliens compared to only 8,000 native-born workers. Look at that. And I actually reported on this. It comes some of the episodes that I had done last year reporting on the jobs report. I reported this. That this, in fact, was the major scandal of what had been reported in the jobs numbers last year. That it was the majority of people that were getting all the jobs. It was all going to foreign-born workers, i.e., illegal immigrants, undocumented individuals. This is just staggering. So, what are you seeing overall in the labor market? You're seeing that, people are taking they have to take multiple jobs. That people are taking 1, 2, 3, 4 jobs to try to get ahead. That's one thing. So a lot of the jobs that were being created were part-time jobs, but even so, the majority of the jobs were going to foreign-born workers, not U.S. citizens. This is just, it's beyond scandalous, And why are people doing that? They're doing that because they are hiring these people to exploit the low labor costs. That's why. That's what it's all about. Low labor costs. They can hire these people for cash under the table, and they, don't have to pay as much taxes, because obviously if you have an employee working under the table, you're not paying Social Security tax and a bunch of other taxes on them. So it's not right. So this means that while we just hit another month of record foreign-born, largely illegal alien workers at 31.774 million, the number of native-born workers remains unchanged over the past 6 years, still below levels last hit in 2019, just before the COVID crisis. And we can see here in this chart here, employed workers, foreign-born. You see in the red here, and in the green over here is native. So what do you notice here? You see the native-born workers, it's stagnating, whereas the foreign-born workers is going up and up and up. This also means that since July of 2018, the U.S. labor force has added 4.6 million foreign-born workers, while the number of native-born workers has declined by nearly 700,000. That's an amazing chart right there. That is an amazing chart right there. And while this not really shocking increase in foreign workers, which really is just the latest in a long series of monthly reports confirming that the only job growth in the U.S. in the past 6 years has been for foreigners, is clearly the result of Biden's policies. We would recommend that President Trump do something to urgently, if not immediately, address this critical topic, a topic which 1 year ago we correctly predicted would win Trump the 2024 election, and which, if left as is, will probably lead to the transformation of the current euphoria in Trump's presidency with disappointment. And I would absolutely agree with that. And then this was an interesting article. I'm not going to get into this whole thing, but it says forecasting error puts Fed on the wrong side again. So it basically, what this article talks about is kind of what I've been talking about tonight. And that is that the Fed probably made a huge mistake in reducing interest rates, what they did, 4 or 5 months ago. And it basically, now they've set this up and they've put themselves basically in a very bad spot. But if you have a minute, go check out this article is a little lengthy. That's why I didn't want to fully cover it here, but great article. Check it out. And maybe next week when I have more time, I'll come back to it. So, all right. So I want to talk about this for just a second here. So this is reverse repo operations. So for anybody who doesn't know, what are reverse repo operations? Well, the New York Fed conducts repo and reverse repo operations each day as a means to help keep the federal funds rate in the target range set by the Federal Open Markets Committee. Operation results include all repo and reverse repo operations conducted, including small value exercises. Now, I want to show you a chart here it's a little crazy here, because you look at this massive spike over here. So what I want everybody to understand, and again, this gets back to the series that I did on the Lords of Easy Money. One of the key things that you have to understand, the major things that the Fed changed about the entire financial system, is the repo market. So think of the repo market as the liquidity for the total system, okay? The liquidity of the whole system. As the repo market, the repo market has to have properly liquidity in it all the time in order for basically the financial system to operate properly. Now, this was one of the major things that the Fed did starting back in 2008. They took the repo market, which was a quiet little sleepy little market in the 90s and in the early 2000s, and they made it the major primary market at the center of our financial system. That's what you have to understand here. So you could see here from some of the blue markings that we had a little up and down here. Now, one of the things that I covered and is a primary feature of the book, The Lords of Easy Money, is basically in 2019, the repo market almost collapsed. And why did you not hear about this? Oh, well, because we had this little thing about 2 months later called COVID that wiped the whole thing off the front page, never to be heard of again. So basically what happened was, in a short, a bunch of hedge funds went in and basically were able to take over the repo market, perhaps under the nose of the Federal Reserve, and they did what was called a type of carry trade. Well, interest rates adjusted a little bit, and that carry trade blew up on them. Liquidity started to sink out of the repo market. The Fed didn't know why, and basically the Fed went and pumped a whole bunch of money into the repo market, basically bailing out the hedge funds. Okay, that's what happened in a nutshell. But look at this. I mean, you saw the liquidity in the repo market got ballooned starting in 2021. They ballooned the liquidity in the repo market all the way up to 2.5. If I could get this little thing at the top here, I can't seem to get it right on the. There we go. Okay, $2.5 trillion is where we topped out here, December 30th of 2022. We topped out here at the top, 2.5 trillion in the repo market. What has happened since? Oh, it has careened all the way down to 100 and where are we at here? Where are we at today? About $187 billion. Just so everybody understands, $187 billion in the repo market is nothing. That is nothing. And I think that this is big. This is big. This is not good. This liquidity basically completely drying up in the repo market is not a good thing. And I would expect something is going to go amiss here in the not too distant future if the Fed does not get more money basically pumped back into this repo market, right quick. So here's how I want you to think about this. So back in 2019, repo market had about, I'm trying to remember the exact numbers back then. I think it was something in the neighborhood of about $2 trillion. So the Federal Reserve goes, okay, let's have an experiment here. How much liquidity needs to leave the repo market before we have a problem, basically before something breaks? And the Fed got that answer at about 1.2 trillion. So about $1.2 trillion, the repo market basically broke. And they said, Houston, we have a problem. And they had to go in and they had to pump a lot more money. Now, they didn't want to pump all that money back in right away because you can't make it too obvious. So they pumped that money in starting in 2021. And like I said, got it back up to about $2.5 trillion here. Now they've let the air out of the balloon again. They've let it come all the way back down. So I am actually amazed because in 2019, if the magic number was about 1.2 trillion, and now we're down to less than $200 billion, that kind of triggers a red flag for me. Sooner or later, something here is going to happen. Something here is going to be amiss. So I point this out just as to we're going to keep an eye on this, and I'm going to come back in the weeks ahead, the months ahead. I'm definitely going to talk a lot more about this. So I want to, like I said, I want to everybody just kind of get the gist here of what's going on in the repo market. I thought this was very important to point out, and we will come back to this later. So, okay, couple quick articles I want to point out, and then I want to take a break for a second because I want to shift gears and I want to talk about economic indicators that are come up next week. I want to give you guys a little bit of banking news before we come back to some of these articles here. But let's talk about a couple of stocks here real quick. So Affirm Holdings. Now, why should you care about Affirm Holdings? I don't really cover stocks here per se on this podcast. That's not really my cup of tea because I don't do financial advice or anything like that. But I wanted to, this was important because Affirm Holdings is a buy now, pay later company. And I've talked a lot about buy now, pay later in the last few months. I just did an episode a few weeks ago where the CFPB just released this whole new report on buy now, pay later and how it was being used. Really fascinating, really interesting. I suggest everybody go check out that video. It's only about a 15-minute video, so it's quick. You can watch it real fast. But Affirm Holdings stock soars on surprise profit as customer base jumps. So Affirm Holdings posted an unexpected quarterly profit as the provider of buy now, pay later loans saw a jump in its customer base. Revenue, active customer base, and gross merchandise volume all came in higher than forecast. The company said it was well on track to meeting its goal of being operating income positive. So is this a good thing? Maybe not. If again, we've seen this explosion in buy now, pay later. Why have we seen that? Well, what was confirmed in that report from the CFPB was that people's credit cards are basically tapped out. And so they're switching gears now and they're going to the buy now, pay later. So I don't know. I don't know if this is a good thing or a bad thing yet. I'm kind of leaning toward bad thing. Because I don't think this explosion in buy now, pay later debt is overall a good thing for consumers in general. So we'll see. But like I said, when I saw this week, this really caught my eye. It really jumped out at me. And I said, yeah, I don't know if that's such a good thing. Super microcomputer. I have not really covered this story, but I probably should. I probably need to do an individual episode just on this because this is a very interesting story. So for anybody who is familiar with NVIDIA, with all the AI that's going on, obviously NVIDIA, one of the biggest chip makers in the world, what they call the Magnificent Seven. So super microcomputer has been caught up in this massive scandal. And but let's just read this for a second here. So Super Micro stock soars further ahead of business update. So shares of Super Microcomputer surged Wednesday for a second straight session after the troubled server maker said it would give a second quarter business update next Tuesday. The announcement raised hopes the firm will be able to submit its delayed regulatory filings and preserve its public listing on the NASDAQ. Despite the recent jump, Super Micro shares have lost more than 50% of their value over the past year amid concerns about the company's accounting practices. So Super Microcomputer, they basically got dumped by their accountant because they have a whole sales scandal going on. And nothing has been confirmed because obviously they're awaiting an audit result. But what has been speculated is that basically, so think about it like this. NVIDIA, the Super Microcomputer, is one of NVIDIA's biggest vendors, okay? One of the biggest buyers, okay? NVIDIA wants to pump their sales. Super Microcomputer's tapped out. They're like, hey, we've spent all our money already. We don't have any more money to spend. Super Microcomputer comes in and goes, hey, no problem. We'll give you $100 million. We just want you to take that $100 million and just give it right back to us by buying $100 million worth of our product, because that's going to help us to juice our sales. Okay. That's big. That's illegal. You can't do that. Many companies in the past have done this pump scam and have gotten in major trouble for it. So their accountant, theoretically, on theory, again, nothing's been confirmed yet, but their accountant basically figured this out and said, yeah, we're dumping you, man. So now they did secure another accountant, but that accountant has not given any, so let's see what it says here. Last August, short seller Hindenburg Research accused the firm of accounting manipulation, what I just described. 2 months later, EY, who was one of the big accounting firms, resigned as its auditor, saying it was unwilling to be associated with the financial statements prepared by management. Okay, that's pretty damning. So now because they have not filed their regulatory filings, they are in danger of being delisted by, I think they trade on the NASDAQ. Yeah, I think they're on the NASDAQ. Yeah, they're on the NASDAQ. So they're in danger of being delisted on the NASDAQ because they have not filed their regulatory filings, and they're obviously under a lot of scrutiny by the SEC right now at the moment. So we'll see what happens here. But again, I thought this is a very interesting story related to Super Micro, and I think that this is a story that could gain steam in the months ahead if these guys are not able to kind of get things together. And this could have a major impact on NVIDIA. And it could have a major impact on some other companies involved in kind of the semiconductor ecosystem, if you will. But we'll, like I said, we'll see what happens with there. I'm going to come back to this in a second. This was a very interesting article. Record number of American CEOs quit. But like I said, we'll come back to that in just a second because I want to get on to some other things here. So first I need to just take a sip here real quick. Okay. All right. So what economic indicators do we have coming out this week coming up? So on Tuesday, February 11th, we have the EIA short-term energy outlook. We have the WASDE report. We have the 3-year Treasury note auction. We have the API weekly crude oil stock. On Wednesday, we get core CPI. We get the CPI for January. We get the FOMC member Ralph Bosnick is going to speak, the 10-year Treasury note auction, federal budget balance for January. On Thursday, we get the continuing jobless claims, initial jobless claims, the core PPI, and then the PPI month over month for January, the 30-year Treasury bond auction. And then finally, on Friday, February 14th, we get core retail sales, industrial production for January, the Atlanta Fed GDP now for the first quarter, and the U.S. Baker Hughes oil rig count. So a lot of inflation data with CPI and PPI coming out. Treasury auctions, we get core retail sales, and then the Atlanta Fed GDP now numbers. So a lot of economic data coming out this week. Can't wait to see it. It's going to be really interesting. So now let me go in and bring you guys a little bit of banking news. So we had the SEC has basically formed this crypto task force. And this week, they basically got together and they laid out their goals. So the Securities and Exchange Commission's new crypto task force has begun working on several priorities, including the security status of crypto assets, custody services, and a cross-border sandbox, according to Commissioner Hester Pierce. Pierce said that as the task force works to develop a regulatory framework, it will give careful consideration to anti-fraud protections. She added that the status of crypto assets under the Securities securities laws is fundamental to resolving many questions, and the task force is working hard to examine different types of crypto assets. So the SEC last month launched the crypto task force to develop a clear regulatory framework for crypto assets and selected peers to lead the group. So obviously we will keep an eye on that with intense interest. General Motors, resubmits what's called the ILC application. So one of the big regulatory hot buttons in banking for many years has been what's known as the ILC loophole. And this is basically a way for banks or for companies to get a bank charter without having to go through what you would consider the normal charter granting process. So General Motors submitted an application to the FDIC and Utah Department of Financial Institutions for GMC Financial Bank, a proposed industrial loan company. GM said the proposed bank will focus on auto lending and deposits. So GM previously submitted an application to form the bank in December of 2020 and withdrew the application in June of 2022 to address FDIC feedback. The UDFI conditionally approved the application in June of 24. Obviously, one of the groups opposing this is ICBA, which has consistently opposed attempts by GM to obtain an ILC charter, noting it would violate the separation of banking and commerce and create a systemically risky financial institution. Given the failure and subsequent bailout of GMAC during the 2008 financial crisis, ICBA has said there is no reason for the FDIC to once again permit this unduly risky business model to re-enter the business of banking. I actually agree. So for anybody that doesn't remember, GMAC failed during the financial crisis, but then you also had what then eventually morphed into what is now known as Ally Bank. Okay, ICBA governance should be left up to the Federal Home Loan Banks. So the Federal Housing Finance Agency should defer to the Federal Home Loan Banks when it comes to the leadership of each bank, ICBA said. In a comment letter, ICBA cautioned the FHFA against being overly prescriptive or undermining the Federal Home Loan Bank authority to effectively populate their boards. ICBA has also said the community banks should continue to have a seat at the table regarding Federal Home Loan Bank governance. So I did a whole episode on this last year. I would recommend everybody go and check that out. The Federal Housing Finance Agency has looked to make a lot of changes over the Federal Home Loan Bank. I'm not really for that. I think that basically the Federal Housing Finance Agency should leave them alone, but more to come on that. So the FHFA also announces a final rule on liquidity for the Federal Home Loan Bank system. So the Federal Housing Finance Agency published a final rule it said would improve access to liquidity to the Federal Home Loan Bank system. The rule modifies the Federal Home Loan Bank limits on the extension of certain forms of unsecured credit. Previously, the Federal Home Loan Bank's deposits held in member-provided interest-bearing deposit accounts counted toward a more restrictive limit set in the FHFA's existing capital requirements. Under this final rule, the FHFA said these deposits will count toward a more flexible limit, allowing the Federal Home Loan Banks to better manage and respond to the liquidity needs of their member. The rule also clarifies terms for the Federal Home Banks to determine limits on unsecured credit to counterparties, and also establishes an exemption for certain amounts in operations and custodial accounts that the proposed rule would have counted toward the intraday unsecured credit limit, and clarifies that the limits are focused on liquidity activities. So I'm sure there will be more to come on that. The Fed's Bowman tailored rules are particularly important for community banks. So tailored regulations are important for all banks, but they are particularly important for community banks, Federal Reserve Governor Mickey Bowman said. Details speaking in Kansas, Bowman said there are real costs to banks and their communities when the regulatory framework is insufficiently tailored. ICBA and other groups oppose bill to set credit card rate caps. So this was kind of big news this week. So basically, ICBA and other financial services groups expressed opposition to new legislation that would establish a 10% annual percentage rate cap for credit cards. So in a letter to Senator Bernie Sanders and Josh Hawley, ICBA and other groups said the 10% credit card interest rate cap would eliminate access to credit cards for millions of consumers and drive them to sources of credit that are more costly and less regulated. I don't know about that. And this is one that I would say I'm a little torn on this one because, on the one hand, I think you kind of run a risky gamble there by trying to cap interest rates. However, I think that the reason why, so think about it like this. You had Bernie Sanders, Democrat, Josh Hawley, Republican, two guys that couldn't be further on opposite ends of the spectrum right now, coming together to propose and put together this legislation for this credit card rate cap. Why do you think they did that? They did that because it has an extremely high chance of passing and getting through. It's a win-win for both sides, and it would be extremely popular. If you're sitting there right now drowning in credit card debt and your interest rates are 25, 26, 27%, and you could get that now capped back down to 10% and have at least a more realistic interest rate, your ability to repay that debt goes way up. So I absolutely understand the argument for it. And when you think about us having a record amount, like 1.4, 1.5 trillion in credit card debt right now for the country as a whole, this would probably be a very good thing. I worry about what you would define as, or what you would call the slippery slope, right? You start going down this, then what's to say you don't cap it at 8% or 5% or 4%, where does it stop basically? And then do you take those rate caps over to other products in other areas? So I worry, where could that go? But in the interim, that might be actually a very good thing. There's no doubt that is going to be an extremely popular course of action on the part of consumers. So, okay. ICBA supports bill to scrap the CFPB's 1071 rule. I've talked about the 1070 rule a lot. Basically, the 1071 rule was part of the Dodd-Frank Act from many years ago, back in 2010. Basically, it said it wanted banks to collect a number of data points on small business owners the same way they collect data points on consumers. A lot of banks have pushed back on that. They have been pushing back on this for years. But anyway, what this says is the ICBA expressed strong support for new legislation to overturn the Consumer Financial Protection Bureau's small business data collection and reporting requirements under Section 1071 of the Dodd-Frank Act. The 1071 repeal to protect Small Business Lending Act, introduced by House Small Business Committee Chairman Roger Williams, would repeal the statute that underlies the CFPB rule. I think it is highly probable that this is going to happen at this point. This is high on everybody's list. I do think there's high probability that probably gets repealed. Okay, FSISAC, more than 69 million has been stolen from crypto platforms. So more than 69 million was stolen from crypto platform Femex in a suspected cyber attack, the Financial Services Information Sharing and Analysis Center said in its latest weekly risk summary. The Singapore-based cryptocurrency platform was forced to pause some of its operations on Thursday after the cyber attack. The company said it is in the process of restoring withdrawals on the platform and will be manually reviewing requests to pull money out of Femex, if I'm saying that correctly. State associations asked Congress to support community bank legislative agenda. ICBA and 44 state community banking associations sent letters to the House, to the Senate, and House of Representatives supporting the community bank legislative agenda. So there you go. So they got some good support there from state banking regulators. This is what I talked about earlier. So Bessent, named as acting CFPB head, freezes rulemaking. So according to media reports, Bessent ordered the Bureau to stop most activities, including rulemaking, which was a good thing, which I had reported on earlier. Sheila Blair, policymakers should rethink credit union tax subsidies. This is a big one. As policymakers consider tax reform, it is time for Washington to re-examine credit union tax subsidies that cost taxpayers billions each year. Former FDIC Chairman Sheila Blair wrote Sheila Bair wrote in a new op-ed. So obviously the pressure on Congress to do something about basically the credit union tax subsidies, I think that's going to reach kind of a boiling point this year, and we'll keep an eye on that and see what happened there. Again, Fed Bowman calls for tailored regulations. Agencies to hold public regulatory review in March. I think this is a big thing. So the federal banking regulator said they will hold a virtual public outreach meeting on Thursday, March 6th, as part of the current economic growth and regulatory paperwork reduction act review. The meeting will allow stakeholders to present their views on 6 categories of regulations: applications and reporting, powers and activities, international operations, consumer protection, directors, officers, and employees, and money laundering. So individuals interested in providing oral comments must register by February 14th. The agencies will notify those individuals selected to provide comments. So so that, I think that will be a very interesting one to see. So what are some other things that were happening right at the second? So the Federal Reserve has discontinued its exploration of a central bank digital currency, a CBDC, for interbank transactions. Fed Governor Christopher Waller said at a speaking engagement, which was reported by American Banker. Waller said that the term wholesale CBDC has been removed from the Fed's terminology, as the existing digital bank reserves already serve that purpose. So I think good and bad there. I'm kind of disturbed by that last comment, that we removed the wholesale CBDC terminology, but the existing central bank reserves already serve that purpose. Digital bank reserves already serve that purpose. I'm a little disturbed by that comment, because it's kind of like, yeah, we're not going to call it that. We're not going to use that terminology, but it doesn't really matter because we've done this anyway, and we've already created this, and so we already have it. So we'll just call it something else, or maybe pretend it doesn't exist for the moment. So a little kind of disturbed by that. USDA projects farm sector income to increase in 2025. That's good. U.S. banks and regulators face scrutiny as lawmakers investigated claims of service denial to specific industries and political groups, a practice known as debanking. Reuters reported. Testimonies included representatives from Anchorage Digital, a cryptocurrency platform, claims to have been debanked, and Old Glory Bank, which brands itself as a response to debanking complaints about large lenders. Yeah, so there was basically a big meeting on debanking this week, where a lot of people came and expressed a lot of, concerns, and I'm sure that we're going to hear a lot more of that in the months ahead. Let's see here. Service sector index increases in January. What else do I got here? Cryptocurrency platform Coinbase is asking U.S. banking regulators to clarify or modify their positions to enable banks to provide custody and trading execution services for cryptocurrency. Bloomberg News reported. I don't want this. I do not. Like I said, until more regulation has been established around cryptocurrency, it is not a good idea to begin flooding the banking industry with digital assets. I think that is a horrible, reckless idea, and I'm hoping that does not come to pass. So, okay. What else do we got? I got some economic indicators from this last week. So factory orders declined in December. Job openings were also down in December. So the number of job openings decreased to 7.6 million in December and was down by 1.3 million over the year. Construction spending was up in December. Manufacturing also expands in January. And personal income and spending rise in December. So personal income increased 0.4% and consumer spending rose 0.7% in December, the Commerce Department reported. Okay, so now let me just give a rundown on. I want to just give a rundown real quick on some of the episodes. What episodes that I had that came out this week? So on Monday, I did episode 312, which was called Are Regulators Concerned About CECL? So that episode I thought was really interesting, giving an update on what was going on. So if anybody doesn't know about CECL, that is called the Current Expected Credit Loss. And that was a way that banks basically calculate their loan loss reserves. There are provisions for bad loans, if you will. So CECL got implemented a couple years ago, but bank regulators kind of gave a lot of leeway in the implementation of CECL. Now they're coming back, they're taking a look at it. Regulators by and large have some concerns around particularly commercial real estate. A lot of banks out there have concentration, particularly smaller banks have big concentrations in commercial real estate. So regulators are really going to be looking probably harder at CECL and your numbers. So basically, it would be a good idea, good time for banks to basically take a look at CECL. What data are they using? Maybe look at things that they haven't been using. Look at the quantitative as well as the qualitative factors that are going into it. So check out that episode if you want to hear a little bit more about that. I thought I had so this week I thought I had two phenomenal episodes. So on Tuesday I did episode 313, which was talking TikTok and AI with Alex Blum Creates. Alex Blum, for anybody who doesn't know, she is basically a Gen Z entrepreneur. Love Alex. Shout out to Alex. Shout out to Alex right on here. Alex is basically a clothing designer and manufacturer. And she has some great products for any female listeners out there. Definitely go check out Alex Blum when you have a minute. I think you will love some of the stuff that she makes. She makes everything from shirts to hoodies to T-shirts to nicer stuff, but has all kinds of great stuff. Go check it out if you get a chance. But what I really wanted to focus in on was the TikTok effect. She's got over 100,000 followers on TikTok. She definitely derives income from TikTok. TikTok she uses TikTok from a marketing aspect to really drive sales. And I wanted to really key in on that. Like, how are, for young entrepreneurs that are out there that are leveraging a social media platform like TikTok, how's all the temporary ban that lasted for a few hours? So we really had a great conversation around that, and also around AI. How is she using AI? What's going on with AI at the moment? And how might she use AI going forward? So that was, tremendous episode there. If anybody gets a chance to listen to that one. Then on Wednesday, I did episode 314, was individuals charged in largest U.S. COVID tax fraud scheme. So it was this huge tax fraud scheme that got unveiled, mainly around abuse of what was called the ERC tax credit. So very interesting story. Again, check that out if you're interested in again, just talking more about kind of the different COVID frauds and different stuff that has been going on here the last few years. Then on Thursday, I did episode 315, which was called "Is Starting a Small Business Worth It?" And I thought this was a great topic because I saw it was a really good article on CNBC that basically talked about how this gentleman had started a business and it was actually going pretty good. He was actually pretty successful there in his first year, but then he stopped and he decided that it was better for him to just go get a 9-to-5 job. And I talked a lot about the reasons about this because, working in banking for as long as I have, this is a very common story. You see this with a lot of customers. They go out, they start businesses. And even if they're successful, basically what they find out is that, for all the work, all the time I'm putting into doing this, I'm not seeing the return because it's not as sexy as advertised. What a lot of people don't understand is, especially when you're building a business, like when you're building a business, it could take you 5, maybe 10 years to actually build that business up and turn it into something good. And in the meantime, you could be working 7 days a week. You could be working 12 hours a day, 15 hours a day to make that a reality. And the question is, what does that do to your lifestyle? What does that do to, if you have a family at home, what does that do to your family life? It puts a lot of pressure on your family life. And there's a lot of times when it's better to just have a 9-to-5 job. You might make more money, have a lot less stress, and you work 8 hours. Maybe some days you put in a few more hours, but for the most part, most days you put in your 8 hours and you go home. You spend time with the family. You're able to pursue more hobbies. You just you can lead a better, healthier lifestyle, and there's nothing wrong with that. That's the key. That's a key point thing. There's nothing wrong with that. When let me put it to you another way. You think about Elon Musk, right? And everybody looks at Elon Musk and they go, "Oh, maybe some people have the thought, wouldn't it be wonderful to be the richest man in the world? And wouldn't it be wonderful to be worth $153 billion, whatever he's worth, to be able to afford every toy in the world, whatever. But I would always ask people this question: would you be willing to make the sacrifice that he did? In other words, Tesla was on the brink of bankruptcy. He was this close to bankruptcy. And he went and he slept on the factory floor as they were making cars. They were literally building the factory as they were trying to roll cars off the line. It was, I mean, I remember seeing pictures of it. It was wild watching these guys literally building the factory as they're trying to roll cars along the conveyor belt and get the cars finished. And he literally slept on the factory floor. Who knows? Every night for months. He was there at the factory. Never didn't go home. Didn't see his family. Slept at the office. Slept on the floor. Made whatever it took to get the job done. And I always ask people, would you be willing to make that sacrifice? Would you be willing to go sleep on the factory floor? Because that's what it takes to be successful. That's what it takes to make a business successful. And that's really the question you have to ask yourself. And that's what that episode was all about, is trying to figure that out, Okay. And then finally, I did a very special episode on Friday. I did episode 316, which was called Chaos in Kansas. It was a conversation I did with Alan Berkeley, who is a friend of the channel. Alan and I were doing this little series that I was calling Conversations. It was kind of conversations where Alan and I would just, it wasn't an interview. We would just talk about things that were going on in banking. We would say, hey, here was a bunch of topics, and Alan and I would kind of go back and forth, just talking, just offering our opinion on how things were working, how we thought they would play out, different stories. And a lot of those episodes were really good. So if you get a chance, go back and check them out, because I would say that 90% of the topics that we covered or talked about are still relevant right now. But what we covered in this episode was there was a bank out in Kansas, Heartland Tri-State Bank, that failed in June of last year. And I'm sorry, not June of last year, June of 2023. So about a year and a half ago. And the regulators were very mum for a while about this whole thing, because the CEO got caught up in a crypto scam. He got caught up in what is known as a pig butchering crypto scam. And it took over a year, though, for kind of this story to leak out. And it was like there was a lot of kind of mystery around, well, what happened here? Why did it happen? So finally, Bank Director did a huge expose, probably about a 12, 13-page article on everything that happened here, how this whole thing went down. And so Alan and I basically do what I would describe as kind of a read along. We basically read through this article to go over the whole story. But Alan and I talk about a range of things there. The impact of bad leadership, when trust is broken. What is the effect when a bank fails that is at the center of a community like that? It ravages the community, and it has ripple effects through everyone and everything there. It's amazing how much a bank, especially a little bank in a little community, how important it is to the economics, to the life, to everything that goes on. So I thought that I thought it was a fantastic episode. I thought a lot of people would like it. So go check that out when you have a chance. Like I said, Talking TikTok with Alex Blum, Chaos in Kansas. Like I said, I thought really excellent episodes. Go check that out. And then as far as this week is concerned, I have an episode coming out this week. I was able to interview a couple of people from ICBA about their brand new open banking guide, which I covered in an episode. What did I cover that? How long ago did I do it? Was it? So back on December 13th, I did episode 298, which was the 1033 rule, aka open banking update. So I covered a lot in the open banking there, but I was able to really get in depth on the open banking guide with a couple people, with just one individual, but it was Mickey Marshall, who is one of the main regulatory people over there at the ICBA. So that episode will be coming out this week. I hope people will check that out, because I'm really trying to bring a lot of awareness to the whole open banking issue because it is a major issue. I personally am not for open banking. I don't like it. I think the whole thing should be scrapped. But there are people out there. There are certain politicians that do want open banking. I think some of the reasoning there might be very questionable or highly suspect. But anyway, that episode's coming out this week, so go check it out. Okay. I got a few more minutes here, and I want to get back to some articles here. So let's, man, I got too much stuff to cover here. There's just too much stuff to get to. Okay. So this article, really interesting. Record number of American CEOs quit. So ongoing economic and disruptive technological changes are some of the main reasons why leaders have opted to quit. So more U.S. CEOs exited their companies in 2024 than in any year in more than 2 decades, with economic and technological factors contributing to the trend, according to a recent report from global outplacement company Challenger, Gray and Christmas. Last year, 2,221 CEOs quit their jobs, according to the company's January 30th report. The number is 16% higher than the previous record, which was set in 2023 with 1,914 CEO exits. The company began tracking CEO changes in 2002. Also in 2024, 143 founders left their CEO roles, far higher than the 29 in the previous year. So the government nonprofit sector led 2024 in terms of CEO departures, with 492 executives leaving their posts. Healthcare and technology sectors saw more than 200 CEOs exit each, followed by the entertainment, leisure, financial, and services industries sectors, each with more than 100 exits. The environment of economic, political, and regulatory uncertainty that prevailed in 2024 certainly led to many CEO exits. So, again, very, very interesting here. That high number of CEOs turned over. So we will keep our eye out on that, as maybe that's a trend that continues here the next couple of years. So, okay. I probably am going to save this a little bit more for next week, since we're kind of running a little bit short on time here. But the accounting industry CPA shortage may be more complicated than it seems. So for anybody that doesn't know, CPAs right now are facing a major shortage in the industry. Even though I believe accounting was the number one major coming out of business schools for quite a few years, I don't believe it's number one any longer, but it's still, top 3, top 5. So it's a popular area of academia. But once the kids come out, they start working in accounting and they find out, it's not all it's cracked up to be. And they take off and go work somewhere else. But I'm going to save this for next week. And I'm definitely going to get more in depth in this one next week, because I really want to talk about this. So this was an interesting article. What is Philadelphia's exposure to potential cost-cutting efforts in federal real estate? So what this article gets into is the fact that, and again, this is just the Philadelphia for a sample size. So Philadelphia has basically 3 million square feet of space in the Philadelphia area that is basically rented by the federal government. Now, that does not include state and local government. If you add it all up, government takes up a pretty massive chunk of office space in the Philadelphia market, as is true of many other cities around the United States. So basically what this article talked about was, if the Fed starts cutting these leases, because basically people they're going to cut for 2 reasons. They've told people to come back to the office, and they've also offered people buyouts. So if you don't want to come back to the office, you're going to get canned. If you take the buyout, you're going to be gone. So basically what's going to happen here is, one way or another, they're not going to need as much office space as they used to. So if they end up cutting large amounts of this office space, what does this do to an office market that's already under a lot of pressure? So that's the kind of big question there. And it just got me thinking, because if Philadelphia's got this much office space, if you calculate that out amongst all the cities around the U.S., that's probably a pretty big number. So definitely, so like I said, very interesting. More to come on that. So, okay. Baby boomer effect is hitting the housing market hard. So baby boomers own an outsized share of homes in America, and nearly half of them say they'll never sell. About 43% of baby boomers say they will never sell their home, the highest of any generational group. According to a survey of U.S. residents aged 18 to 65 by real estate firm Redfin. The biggest single reason cited for staying in place is that their home is almost or completely paid off, while others say they just like where they live. About 30% say they are staying in their current home because prices are too high, and 18% said they are staying because they don't want to give up their low mortgage interest rate. The survey results are playing out in real time, with a recent Redfin analyst showing just 25 out of every 1,000 U.S. homes changed hands in the first 8 months of 2024, the lowest in decades. And with home prices up about 40% since the start of COVID-19 pandemic, the current mortgage rates are far higher than they were in 2019. Moving isn't as attractive to those that don't have to. So again, this is very interesting because this plays into the inventory, right? You have very low inventory levels. This is part of the reason why housing prices are staying high, because the inventory is so low, because people don't want to sell their houses because, like you said, either they have the house paid off, they're very close to having the house paid off, or they have a mortgage, probably a small mortgage, but they're locked in with very low interest rates. I mean, if you got a 3.5%, 3.75, 4%, you are not giving that thing up, man. You are going to hold on to that thing till you're going to hold on to that mortgage till the bitter end. Okay. And all right, so just a couple other things I want to cover real quick. So U.S. Senate hearing reveals rift in bipartisan effort to address debanking. I kind of talked about this a little bit more, probably go into this a little bit more next week. With basically the whole debanking issue. Republicans urge repeal of CFP rule for banks to collect small business data. I talked a little bit about that earlier. Bank de novos, camels, tariffs among hot topics at House Banking Committee hearing. So big hearing where they talked about a lot of regulation. They want to get de novos going again. Hint of maybe a little bit of bipartisanship there. Maybe. I'm not going to hold my breath. Neither should you. Okay, buyer demand not quite matching seller supply in U.S. bank M&A market. So I'll probably talk about this more next week. So while bank M&A is expected to pick up in 2025, a mismatch in the supply of sellers and the demand of buyers is a challenge to deal making. Yes. And like I said, more on that next week. U.S. Bank's net branch closures declined for the third consecutive year of 2024. So U.S. Bank's net branch closures declined for a third straight year. You can see them kind of going down. So that means banks are closing less branches, still closing more, still more net closures every year, but the pace is definitely slowed. I think we were at a high of... Does it give the exact number of bank branches here? I think we had peaked out a number of years ago at probably about 97,000 branches, and that's probably dropped back down to about 76, 77 total bank branches in the U.S. right now, something like that. Okay, big banks notch deposit growth as they cut funding costs. So big banks successfully cut deposit costs while eking out deposit growth in the fourth quarter of 2024, as what appears to be a short and sharp Federal Reserve rate cutting cycle broadly supported net interest margins. Well, good for the big banks. Bank M&A deal tracker, 11 deals announced in January. So not a fantastic start to the year by any stretch of the imagination. We go down here and look at deal numbers. I'll probably come back to this again next week. But again, 2024 kind of ended. It kind of ended better. You can see this kind of in the graph here. You can kind of see there was a little bit of spike up there in the fourth quarter of last year, kind of like third to fourth quarter going up. Started out the year a little slow, but then things kind of picked up from there. I thought we would only hit in 2023. There was 98 basically M&A transactions. I thought we might get up to maybe 100 or right around the same number. We actually shot up to 126, so it was actually a little bit better year than I thought that probably the industry was going to have. This year, I would suspect maybe the number might get up to maybe 155, maybe a little bit closer to what we did in 2022. But we'll see. But I mean, obviously, 11 deals to kind of start the year is maybe not quite as great as we would have liked. But anyway, okay. I'm going to end with this. I'm going to start a new trend here this week. So I'm going to this week I wanted to talk about this story just because this is kind of like an anniversary. So this is what is known as tulip mania. And I'm going to blow this up here so that basically everybody could get a good look at this. So tulip mania occurred in the Netherlands during the 17th century. Without giving the full backstory on how this phenomenon began, tulips were introduced to Europe from the Ottoman Empire around 1550. These flowers were different from anything in Europe due to their intense color. They quickly became a symbol of status and were seen as luxury items. Speculators entered the market buying and selling tulip bulbs with the expectation of making a profit. As the mania grew, tulip investors began pushing prices to unprecedented levels, with the average price of a single flower exceeding the annual income of a skilled worker. Some even sold for more than the price of a house. Eventually, the story ended as you would expect. People began to realize that these tulips had no true utility and were extremely overvalued. Investors began to sell in a panic. Prices collapsed over the course of a week, and many investors went bankrupt. But tulip mania, you could kind of consider this the first, in a very real respect, you could consider this almost the first real, almost modern era market bubble and collapse. And I have a chart of this on the wall here in my office, and I keep it as a constant reminder to me that you have bubbles. You have bubbles. You have market cycles. You have a business cycle. You have cycles in the market. All kinds of cycles. Market cycles, business cycles, real estate cycles. All kinds of things. But you can have these manias. You can have manias followed by panics. So this was tulip mania, and you could look at the .com bubble. You can look at the Great Recession as a giant credit bubble. But you again, as you study the stock market and you study the ups and downs and you study panics and crashes and manias and all these different things. But I keep this picture in particular because it reminds me that basically you can't get too carried away because you can see here. And there's an overlay on top of this. This is kind of like the tulip mania. The mania you can see here shoots up and then comes back down. But then also you have a lot of the modern day stuff in here. So it starts out with the smart money. It moves to the institutional investors, and then it finally moves to the public. So this is always important to know. The public is always the last to buy in. But that's also the point of the mania phase. So you have the stealth phase, you have the awareness phase, you have the mania phase, and then you have the blow off phase or the collapse. So you have the takeoff, and then you get the first sell off and what's called the boar trap. Then you get media attention, enthusiasm, greed, finally delusion. Then it starts to plunge. You get the denial. Then you get a slight return to normal. And then the plunge happens. And then as the plunge happens, you get fear, you get capitulation, and then you get despair. You hit the bottom, and then it begins to revert back and returns to the mean. That's a statistical thing. The pattern always tends to revert to the mean over time. So, but I love this story. It's a great story. And the reason why I brought it up, because this week, a couple of days ago, it said, on this day in 1637, tulip mania hit its peak in the Netherlands, with the price of the rare Wit Kroenen tulip bulb up 2,506% in 33 days. Over the next 5 years, the bulbs lost an annual average of 76% of their value. So that's a great story. If anybody has never heard of tulip mania, now you have. If you like I said, it's a very interesting story. You should go read it. You like I said, you could see so many parallels and so many patterns from this that have repeated themselves over very many years. So okay, so with that, I'm now going to end with our quote. So what is our quote of the week? So our quote of the week is: there is a tendency for people to expect the status quo either to last indefinitely or to provide advanced signals for shifting strategies. The world does not work like that. Surprise and shock are endemic to the system, and people should always arrange their affairs so that they will survive such events. And that was by Peter L. Bernstein. And I thought that was a perfect quote to complement the story this week of Tulip Mania. And with that, that's all I got for tonight. I thank everybody for hanging out with me. I'll wrap up by saying, if you like the live stream, if you like the channel, please make sure to like, share, and subscribe, as that really helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And remember to check out some of the other content on the channel. Next week, I will be back at the usual time, Saturday night, 8 p.m. And I just want to say, go Eagles this weekend. I really hope they bring home another Super Bowl trophy. Chiefs, boo. Boo. Yeah, don't like the Chiefs anymore. They won their 3 Super Bowls. They don't need any more. Go Eagles. So anyway, with that, have a great night. Have a great weekend, everybody, and I'll see you again soon.